In the next few minutes, we'll unravel the electrifying story behind Saylor's headline-grabbing Bitcoin crusade. You'll discover the mind-bending numbers, the intense controversy, and the very real risks fueling heated debates on Wall Street and in the cryptosphere alike. Whether you're a crypto diehard, a skeptic, or just fascinated by high-stakes business drama, you're about to see how one eccentric billionaire's obsession could tip the scales of the modern financial world. So what drives a man to transform his $40 billion company into a fortress of Bitcoin? And what happens if the bedrock under that fortress suddenly cracks? First, let's rewind to understand how strategy rocketed from corporate obscurity to the front line of the Bitcoin revolution, a journey marked by wild ambition, relentless criticism, and some of the highest stakes in digital history. Before 2020, strategy was flying under the radar, a profitable but unremarkable enterprise software company, respected but hardly revolutionary. Its co-founder, Michael Saylor, was known for his intelligence, his resilience after surviving the dot-com crash, and frankly, his flair for bold pronouncements. But few could have imagined what was coming next. In August 2020, as the global pandemic unleashed chaos on markets and central banks flooded the world with liquidity, Saylor made a move that stunned his board and delighted crypto advocates worldwide. He announced that strategy would begin shifting its corporate treasury, a war chest once stuffed with dollars, into Bitcoin. His argument? The US dollar, and indeed fiat money everywhere, was being relentlessly devalued by inflation. Saylor saw Bitcoin as digital gold, scarce, decentralized, and immune to the printing presses of governments. And he didn't tiptoe in. Over the next 5 years, Saylor led strategy to accumulate a jaw-dropping 582,670 Bitcoins. As of June 2025, the company's aggregate Bitcoin purchase price, $40.7 billion. To put that in perspective, strategy now holds more Bitcoin than the combined reserves of many major exchanges. It's the single largest publicly known corporate holder on the planet. Saylor himself became a media fixture, mixing technical arguments with philosophical manifestos. Bitcoin, he declared, is hope. He urged other companies and even governments to follow his lead, warning that sitting still would be financial suicide in a world of vanishing currency value. Strategy's campaign quickly became a rallying point for crypto bulls, but also a lightning rod for controversy. Financial titans like Cathie Wood of ARK Invest publicly predicted Bitcoin is on its way to $1.5 million by 2030, driven by institutional adoption and scarcity. On the other side, traditionalists shook their heads in disbelief. Critics asked, is Saylor brave or reckless, gambling shareholder value on an asset with a reputation for wild price swings? To fan the flames, Saylor's buying strategy was more aggressive than most imagined possible. Strategy financed part of its acquisition spree with debt, issuing convertible bonds and taking on billions in obligations. This leverage amplified potential gains, but also potentially catastrophic losses if Bitcoin's price were to collapse. Yet Saylor seemed unfazed. In public appearances, he spoke of Bitcoin as an unassailable fortress, stating, "Every day we don't own Bitcoin, we're losing ground." Over time, strategy became a bellwether for institutional participation in crypto. Every major purchase was telegraphed with bold tweets. Saylor even joked, "Orange is my preferred color," a cheeky reference to Bitcoin's logo. Crypto Twitter exploded each time, and market analysts pored over every signal from Saylor's social feed. Not everyone was convinced, though. JP Morgan, the banking giant, acknowledged that strategy's purchases were a bullish catalyst for Bitcoin. However, the bank also recognized that these moves hadn't caused as much market volatility as expected, because savvy traders had already priced them in. Still, the sheer size of strategy's holdings meant their every move could, in theory, jolt the entire market. But this wasn't just about price. As Bitcoin's supply was slashed by the April 2024 halving, an event that reduced mining rewards to 3.125 BTC per block, the scarcity narrative grew stronger. Advocates like on-chain analyst Willy Woo proclaimed, Bitcoin's network fundamentals remain strong, with increasing adoption and decreasing exchange balances. Institutional FOMO set in. Everyone from family offices to sovereign wealth funds began taking small steps into Bitcoin, inspired or perhaps unnerved by strategy's conviction. Meanwhile, strategy's breakneck accumulation sparked fierce debate about Bitcoin's future. What if other companies start following Saylor's lead? Asked investment strategists. Could this drive global adoption, or will it centralize too much influence in the hands of a few? By June 2025, with 582,670 BTC on its books, Strategy had become synonymous with Bitcoin's fate. Yet for all the praise, a growing storm was brewing. First, there was the elephant in the room: transparency. In a world rocked by exchange meltdowns and fraud, the crypto industry had begun to rally behind the concept of proof of reserves, a way for institutions to transparently demonstrate that they really held the assets they claimed. Many reputable firms adopted on-chain proof of reserve systems. These cryptographic proofs used public blockchain data to give investors and the broader public confidence that funds weren't being fractionally reserved, rehypothecated, or, in the worst cases, simply missing. As Nick Carter, a leading venture investor, asserted, proof of reserves are a crucial step for building trust in the crypto industry. But Saylor and Strategy refused to play ball. Citing security concerns, Saylor dismissed the idea of publishing on-chain proof of reserves for Strategy's holdings. The backlash was immediate and intense. Crypto analysts accused him of hiding behind excuses. Social media buzzed with conspiracy theories. Was Strategy really backing up its bold claims, or was it holding paper Bitcoin, mere claims on Bitcoin rather than the real thing? Arkham Intelligence, a leading analytics firm, tried to put the rumors to rest, tracking addresses believed to be associated with Strategy. But the lack of absolute cryptographic proof left a sour taste in many mouths. For an industry obsessed with trustlessness and transparency, this was a glaring contradiction. Then came the structural risks. Strategy had issued billions in debt to fuel its Bitcoin buying spree. Yes, as long as Bitcoin soared, the company's market cap ballooned, shareholder value skyrocketed. But what if a regulatory crackdown or a brutal bear market hit? The company could find itself over-leveraged, forced to liquidate Bitcoin at a loss, triggering a vicious spiral for crypto prices and potentially setting off a crisis of confidence in the nascent institutional adoption trend. Bitcoin's volatility will continue to decrease as the market matures, insisted Michael Novogratz, another prominent crypto billionaire. But history shows that Bitcoin's price can swing 30% in a matter of weeks. Even a temporary plunge could send Strategy's balance sheet into the red, jeopardizing its ability to service debt or even survive as an independent company. And the threats weren't just financial. Governments worldwide, from the US to the EU and China, are growing increasingly wary of the crypto sector's systemic risks. Regulatory pressure mounts with every new scandal, every exchange hack, and every hint of market manipulation. In the words of Lynn Alden, a respected investment strategist, Bitcoin is a compelling long-term store of value, particularly in an environment of fiscal and monetary uncertainty. But she also warns, regulatory risks are real, and overexposure leaves companies like Strategy vulnerable. Recent events have only intensified scrutiny. In June 2025, Strategy announced yet another $427.1 million Bitcoin purchase, drawing both cheers from Bitcoin maximalists and fresh criticism from skeptics. After Saylor openly rejected on-chain transparency, regulatory hawks and skeptical investors sharpened their knives, questioning not just his judgment but the foundation of Strategy's entire approach. As if foreseeing the mounting difficulty, Saylor recently quipped that it would get exponentially harder to buy Bitcoin in the future. Was this a warning to the masses, or clever psychological gamesmanship to pump prices further? Now, with over 500,000 Bitcoins on the books, billions in debt, and the eyes of regulators and the crypto world fixed squarely on Strategy's every move, we stand at a tipping point. Will Michael Saylor's all-in gamble immortalize him as a visionary who changed finance forever, or as the architect of one of the most spectacular corporate collapses in the digital age? And most importantly, how vulnerable is Strategy to a sudden storm, be it from a regulatory crackdown, a technological shock, or a devastating market meltdown? The next chapter could rewrite the rules of not only crypto, but the entire global financial system. As the dust settles from Strategy's latest headline-grabbing Bitcoin purchase, the world is left asking, what comes next for Michael Saylor and his audacious corporate experiment? The second act of this high-stakes drama is just beginning. All eyes are on the horizon, to the risks, the opportunities, and the potential consequences, not just for Strategy, but for the entire digital asset ecosystem. Let's break down the three scenarios that could define the future of both Saylor and his company. First, there's the world in which Strategy's Bitcoin bet pays off in spectacular fashion. Imagine a future where institutional adoption accelerates, the regulatory picture remains favorable, and Bitcoin surges to dizzying new heights. Some visionaries like Cathie Wood predict prices could reach $1.5 million by 2030. In this reality, Saylor's foresight cements his company as the undisputed corporate king of crypto. The $40.7 billion spent on nearly 600,000 BTC becomes not just a wise purchase, but a generational fortune. This scenario would echo through boardrooms worldwide. Instead of being an outlier, Strategy's approach could become a blueprint for corporate treasury management. We could see a domino effect, with other publicly traded giants following suit, increasingly diversifying away from fiat currencies and conventional assets. As Saylor himself once tweeted, "Orange is my preferred color," a playful nod to Bitcoin's orange logo, but perhaps also a subtle signal. The future is bright, and it's drenched in Bitcoin. But that's just one possible path. Let's imagine the second, less rosy scenario. Regulatory roadblocks begin to rise. Across the globe, governments and financial watchdogs are growing warier of the influence wielded by both Bitcoin and its most fervent corporate supporters. What if new legislation restricts how much Bitcoin a public company can own? What if tax frameworks become punitive, or if holding digital assets invites relentless scrutiny from regulators? It only takes a single major shift, say the SEC finally labeling certain aspects of Strategy's operation as a risk to market stability, for the company to be forced into defensive maneuvers. In this world, Saylor's empire could face fines, forced liquidation, or even lawsuits from investors who feel they were not adequately warned of the risks. Pressure might build for Strategy to diversify, to unwind some of its massive Bitcoin positions, or to adopt proof of reserves transparency measures that Saylor has thus far resisted. The narrative could change overnight, from trailblazing visionary to reckless gambler caught in regulators' crosshairs. And then there's the wild card, technological disruption. While Bitcoin is the current king, the cryptosphere doesn't stand still. New blockchain networks and assets are emerging constantly, promising faster speeds, lower costs, or greater privacy. Imagine a scenario where Ethereum, Solana, or an as-yet unknown contender surges ahead technologically, gobbling up mindshare and market cap. Suddenly, Bitcoin's primacy could be threatened, and a company with billions locked up in Bitcoin would face enormous opportunity costs. If that happens, would Strategy be nimble enough to pivot, or would Saylor's conviction become a golden cage? These scenarios aren't just abstract thought experiments. They're potential real-world outcomes, shaped by forces already in motion. As investment strategist Lynn Alden points out, Bitcoin is a compelling long-term store of value, particularly in environments of fiscal and monetary uncertainty. But that same uncertainty cuts both ways. If markets lurch, if global capital flows shift, or if a major player stumbles, the impact could be seismic. And for a company that's staked everything on a single asset class, there's precious little margin for error. So what does all of this mean for you, the viewer? After all, you're not running a multi-billion-dollar public company, but there are crucial lessons here for anyone interested in finance, technology, or the future of money. First, understand the power and peril of going all in on conviction. Michael Saylor's story is, at its core, about taking a well-researched, high-conviction view and acting on it, regardless of mainstream skepticism. For the average investor or entrepreneur, that can be inspiring. It shows the importance of independent thinking, of being willing to make bold bets when you believe in your thesis. But Saylor's saga also highlights the dangers of concentration. Diversification exists for a reason. While Strategy's bet could yield outsized rewards, it also exposes the company to unhedged risk, from Bitcoin's price swings, regulatory shocks, or technological obsolescence. The lesson is clear. Conviction is vital, but blind faith can be fatal. No asset, however compelling, is immune to disruption or decline. Transparency is another key takeaway. Saylor's recent refusal to publish on-chain proof of reserves has drawn widespread criticism, not only from skeptics, but from thoughtful industry insiders. Nick Carter, a well-respected voice in crypto, put it bluntly: proof of reserves are a crucial step for building trust in the crypto industry, and Saylor's rejection is disappointing. For investors or companies involved in digital assets, the lesson couldn't be clearer. Trust is earned, and in the world of blockchain, transparency is both possible and essential. Third, always be ready for change. The world of cryptocurrency moves at breakneck speed. What's true today may not be true tomorrow. Technological, regulatory, and market shifts can come from surprising directions. Whether you're investing, building, or simply following this story, keep your eyes open and your mind flexible. As Michael Novogratz notes, Bitcoin's volatility will continue to decrease as the market matures and institutional participation grows. But volatility never disappears entirely, it simply changes form. And a final, perhaps less obvious lesson, the importance of narrative. Saylor's relentless media presence, his confidently delivered sound bites, and his memes, like "orange is my preferred color," are not accidental. They're part of a larger strategy to shape perception, mobilize supporters, and drive adoption. Whether in crypto, business, or life, understanding and influencing narrative is a powerful tool. Just as Saylor has used it to rally the Bitcoin community and draw institutional attention, you too can harness the power of storytelling in your own projects. So, will strategy's bold gamble weather the coming storm, or collapse under the weight of its own ambition? The answer, as so often in finance, is that it depends on a volatile mix of market forces, regulatory actions, technological breakthroughs, and good old-fashioned luck. If Bitcoin's long-term narrative holds true, Saylor's company could become the Berkshire Hathaway of the digital age, a case study in visionary risk-taking. If headwinds gather, though, it might serve as a cautionary tale of hubris and overreach. But here's the secret fact most casual observers miss. Saylor's play isn't just about maximizing upside. It's also a bet on survival, a hedge against the collapse of traditional currencies, inflation, and the unpredictable tides of global finance. By transforming his company into a Bitcoin fortress, Saylor isn't just chasing profits. He's building a lifeboat for what he sees as a stormy future. Whether or not you agree with his worldview, it's a vision that demands attention. So what should you do now? Stay informed. Question bold claims. Diversify your thinking and your assets. Look beyond the headlines and ask yourself, where do I see value, risk, and opportunity in this new world? And remember, every financial revolution is driven not by inevitability, but by individuals willing to challenge consensus, sometimes succeeding, sometimes failing, but always moving the story forward. If you found this deep dive valuable, make sure to like, subscribe, and share your thoughts in the comments. What do you think about Saylor's approach? Is he a genius or a gambler, or both? And most importantly, what would you do if you were in his shoes? Let's keep the conversation going, because this story